I'm glad to be here. I've actually wanted to come here for many years, and kind of like Jim said, Quincy used to come up here on a regular basis. I know he's a familiar face to everybody in here, and I would like you guys to do me a favor if that's possible. So, and first let me just tell you a story about how Quincy told me about coming to this event. He pulls me into his office and he says, Nate, I got a problem. I need you to take a presentation for me. I'm like, sure, Quincy, no problem, anytime. He goes, I want you to go up to Virginia, speak at Jim Ingersoll's group. And I go, I love Jim, and I've actually never had an opportunity to go up there. So no problem, Quincy. He goes, because I have this other presentation that I have to do. And he made it really somber, like he had to go work and do this other thing. So I was, going up to bat for him. And I go, sure, Quincy, where's the presentation at? Where are you working? He goes, it's in Mexico. I go, oh, okay, Mexico. Wow, that sounds really tough, Quincy. Your life is really hard. So we're gonna do a little thing for Quincy and make sure that he's not missed. So I've got Derek here, he's got his camera out here. And then what I wanna do is just do a collective awe, if we can, about Quincy being in Mexico. So let's just do that on 3. Quincy being in Mexico, 1, 2, 3. Aww. Make sure that gets to Quincy. So thank you guys, I appreciate that. But I am excited to be here, and what I wanted to do, since this is first day, we're early, I want to kind of just go over self-directed IRAs, why they're important, what you should be thinking about when you think about self-directed IRAs and your investments, whether they're real estate or anything else. But I also want to use it as a setup for some of the other speakers that are following me, because a lot of the other speakers are either Quest clients or you'll see them on the IRA fund cruise. They've got a lot of great information, so this is kind of the foundation to what they're going to be teaching, whether they're teaching about private money lending or investments into joint ventures. All of it can be related back to self-directed IRAs. Okay, so we'll talk about what types of self-directed IRAs you guys should be thinking about, how to set those up, and at the end, I'm going to talk about maybe the 3 top strategies that I like to use, and I see, not giving investment advice, but some of the things you guys might think about in order to build tax-free wealth using these self-directed accounts. Let's see if get this clicker working here. All right, so this is just a little background on me. I know a lot of people know me in this room, and this isn't to impress anybody or anything like that. It's really just to give you an idea of how I got here and why I'm on this stage right now. What's that? War Eagle, there we go. Okay, I actually, I went to Auburn University. Anybody SEC? I was on a baseball scholarship there, played in the World Series. Actually, in 1997, I was on the World Series team. Graduated from the University of Portland with a business degree. Not that that is impressive to anybody, but I will tell you, I have learned more outside of college, obviously, than I did in college. I don't think that anything that I do now, I can relate back to anything that I learned in the classroom. Not a knock on college. But what I will say is that you guys sitting in this room and hanging out with the people that you get to hang out with, you're gonna learn so much. So for whatever you guys paid to be here, I guarantee you it's worth it, because I've learned more in my lifetime in the 8 years of being at Quest than I have in the other years that I've been on this planet. So after college, I had a stint through the corporate, all real estate related corporate field. I started right in real estate, working as a residential loan officer, so I got a lot of background in lending. I did that for many, many years. I invested in real estate, through those times as well. Experienced the crash, just like probably all of us in here experienced the crash. I got a lot of lessons through that. And then about 8 years ago, I was approached by Quest. Okay? Back then they were Quest IRA, now we're Quest Trust Company. But they approached me, I had a friend working there, and they brought me out to start working. I was looking for a new career opportunity, something to get me out of that corporate lending, real estate type stuff. And that's when I met Quincy and his brother Nathan, and they started teaching me about these self-directed IRAs. And for a lot of people, I'm sure you're familiar with this, I thought, what is a self-directed IRA? Right? How come I've never heard about it? I've worked for big banks, small banks, Royal Bank of Canada, banks here in the US. I've worked for all sorts of companies. No, I even had a financial advisor. He never told me about using a self-directed IRA to grow my wealth. I just invested my IRAs and 401ks in the stock market. So at first I thought it was illegal. I said, who's this Quincy guy and why is he telling me to do illegal stuff? Okay? But then as I found out, man, these guys really know what they're talking about here. And how come everybody doesn't understand? How come everybody doesn't know this? They didn't teach me this in college, right? Why would they? So I started working with Quincy and Nathan, and at this point now I'm actually, I find this a passion. I love talking about this type of stuff because it gives people that aha moment that they say, you know what, I've never been taught to invest that way, and I didn't know that there was this other way. Or Quincy likes to say, you're not thinking outside of the box, you're just realizing the box is bigger than you realized. And I know a lot of people in here know what a self-directed IRA is, but for those of you who don't, we're going to talk a little bit about that. I will tell you that Quest is expanding. I know we got a lot of Quest clients in here. The reason why I want to just bring that up is that we're going to be opening offices all over the country, and a lot of them might be closer to here. So if that interests you guys, we're going to be closer to your neck of the woods, but right now we're based in Houston, Texas. So that's just a little bit of background about me. And of course, a lot of you guys know Quest, what we are, and I'll talk about that for people who are not familiar. We are a self-directed IRA company. What does that mean? Okay, self-directed IRAs just mean they're IRAs that allow you to invest in alternative assets. Okay? We're a company that administrates the IRAs for that purpose. But Quest doesn't sell investments. We don't sell investments to our clients. So even though we're a custodian like a Fidelity or Charles Schwab, we don't sell investments like Fidelity or Charles Schwab. We give our investors keys to the car. We let the investors, our clients, choose their own investments. Okay? So when you talk about self-directed IRAs, don't get confused with that term self-directed. IRAs are IRAs or IRAs. IRAs are all the same no matter where you go, and all the rules are the same. It's just depending on where you park your IRA, the companies restrict you or prevent you from investing in certain things. Okay, so most of our clients have IRAs at Fidelity and Charles Schwab, and they also have IRAs at Quest. We'll talk about why that's important to do that. But don't get confused with the term self-directed. Self-directed is just a marketing term. Okay? We currently have about 20,000 clients, $2 billion under administration, and continuing to grow. And I will tell you, out of all the self-directed IRA companies in the country, I believe that we have the most certified IRA services professionals, 34 at this point, which means it's just a nerdy term for us IRA guys, where we take an exam by the Banking Commission and basically hold it on our hat. So it's like the bar exam for self-directed IRA investors or self-directed IRA employees. $350 million in cash. Why do I have that up there? We'll talk a little bit about that as we go on, but one of the things when you think about retirement accounts is that what self-directed IRAs allow you to do is not only use your own retirement accounts to invest in the things that you're learning about today, whether it's real estate, joint ventures, or otherwise, and why that's important to grow those investments of your own tax-free or penalty-free, but there's all other opportunity that opens up for you when you start understanding how these accounts work. Okay. That's the opportunity to use other people's self-directed IRAs as a private capital source. Does anybody currently use other people's IRAs to fund their deals? I know Jim talks about it a lot. About half of the room understands that. But I will tell you, if you're going to be an investor of any kind, real estate or otherwise, you want to understand where to get money. Okay? Most people don't think to look at retirement accounts as a source of capital. It's probably one of the best sources of capital, especially for those of you who might be over-leveraged at a bank, you've got your 10 loans, or you're just looking for quick money that you can pay above average interest, and it doesn't affect your credit, and it doesn't affect your income. Okay? Self-directed IRAs allow you to do that, and we'll talk a little bit more about that, but that $350 million in undirected cash is just what Quest has sitting in cash. Okay, what's that mean to you? Is that's an opportunity for you guys to network with other Quest clients and ask them what they're invested in. Unfortunately, you can't come to me. I can't give you the list of who those clients are. Okay? We have privacy agreements with our clients, but that's just a drop in the bucket as well. Okay? There's $30 trillion in retirement accounts. I don't know if you guys realize that. 30 trillion with a T. Okay? Out of that 30 trillion, the largest bucket of retirement is now IRAs. It's no longer 401ks. It's actually IRAs make up $9 trillion in this country. Because a lot of people, when they move companies, their 401ks turn into IRAs. So you always should have that on your radar, self-directed IRAs. What are my self-directed IRAs doing, and how can I build my wealth for retirement tax-free, and how can I use other people's self-directed IRAs to fund more of my personal deals? So, kind of talked about this. What is a self-directed IRA and why you should have one? Here's some of the reasons why I think everybody in this room should have a self-directed IRA. I kind of mentioned a lot of our clients have IRAs at Fidelity and have IRAs at Quest. Most of you guys understand why you would want to do that. But one of the biggest benefits is obviously you are allowed to diversify your portfolio, right? Nerdy wealth builder you talk there. Why do you think most people have their IRAs just sitting in Fidelity though? 98% of America's retirement is invested in those traditional investments. Why do you guys think most people invest that way? Safety. Easy. Be easy. Ignorance. I didn't say it. He said it. All right. I would say most people just don't know. They don't know what their options are. Right? Safety, security, you could say all that stuff, but I can also say that same stuff for the assets that we hold at Quest. When you talk about real estate, I would say real estate's a safe investment if you understand how to manage it, right? Ease, obviously there's easy ways to use self-directed IRAs, but I would just say most people don't know. They don't know what they don't know. So this is the good thing, this is why I'm passionate about teaching this, because I didn't know this type of stuff. And I think everybody should understand this, that whether you're an investor of any type, I think it's important to understand the benefits of real estate in a retirement account. Okay? Because most people just invest in stocks. We know the dangers of investing in stocks. Sometimes it goes up, sometimes it goes down. I know it's been going up for a little while now, but you never know when it's going to go back down. But the main difference between a bunch of stocks and real estate is what I think is it's one's tangible and one's not. Right? If you own a mutual fund, it's got a bunch of stocks in there, and you hit 2007 or 2008, whatever you call it, and you're invested in companies that go out of business, what are you left with? Nothing, a piece of paper, and that paper is basically not worth anything. There's no collateral to that type of investment. If you look at real estate's fundamentally different because real estate is always tangible, right? Real estate, you can drive by it, you can touch it, you can feel it. It's a tangible investment. What's the worst thing that can happen if you own a piece of real estate? It can go down in value, right? Just like the stock market does. It can go up and down in value. Okay? But if you look at any conservative reports, real estate goes up at least about, on average, 5% a year. Okay? Take real estate now and go back 15 years in time. At almost 99.9% of the time, real estate's worth more than it is today than it was 15 years ago. So it has its ups and downs, but again, it's always tangible. But here's the other thing that I like about real estate, is that even if your property is going down or the property value is stagnant, is that the only way that you make money on it? By just appreciating? No, cash flow. And sometimes on your real estate investment, cash is king. Cash flow is king. So not only is real estate within an IRA a tangible investment that you're not going to lose, okay, but it's also an ability where you can have multiple income streams that act as a counterweight to anything, any markets that were depreciating in our real estate market. So the ability to have real estate in an IRA is key whether you're a real estate investor or not, because of that fact that it's tangible and you can build multiple streams of income. But this is the main thing, and this is what every investor should understand, is that IRAs and 401ks and qualified plans give us tax benefits that we don't get as individuals. Okay? I'm a taxpayer. Everybody in this room is a taxpayer. Okay? Whether we're investing in our own name or in our LLC, we end up having to pay tax on our profits. So here's one of the hard parts about being in the retirement industry, is trying to teach people about the importance of having investments in a retirement account. Okay? Because I think most people get caught up in this rat race and they spin their wheels trying to get to retirement. And what do I mean by that? They think that they have to make money first before they start putting money in their retirement account. You know what ends up happening with that philosophy? Is that you just are a taxpayer until the day you die, and you never find yourself with enough money for savings. Because if you're going to be an investor and you invest $100,000 of your own money as your name or your LLC, you got to pay your silent partner, Uncle Sam. So 40% of your profit go back to Uncle Sam, so your bucket grows slow. Okay? And you never really get to where you want to go because you're eaten up with taxes. Okay? You guys know what the average American family has in a retirement account in this country when they retire? You guys know? $65,000. How long does $65,000 last us? Not very long. I know some people in this room looking around, I know you can spend it on one IRA fund cruise. Okay? But I think that has to do with us not planning ahead. So self-directed IRAs allow diversification, but they also allow you to grow your investments completely tax-deferred, or even better, tax-free. And we'll talk about the different types of accounts. I'll talk about the power play that I like to use with my investing and what Quincy and everybody at Quest likes to use to get us the best tax savings possible. The other thing self-directed IRAs allow you to do is just be more socially conscious with your investments. I know that sounds cheesy, but I see it on an everyday basis. Okay? For those of you who raised your hand that talked about I use other people's IRAs to fund some of my deals, okay? If you are a rehabber, and I'll give you my own personal example, I actually, since I come from the lending world, and Quincy and obviously they taught me that I can lend out of my IRA, I just like being a lender. Okay? I like being the bank. I like to loan my Roth IRA, my HSA, and all the accounts I'll talk about. I like to loan it to real estate investors. Who in here wants to borrow my money right now? Okay, so he's the closest, and I have a hard time seeing, so I'll just use his as an example. And I don't know, I haven't met you yet, but what type of investor are you? Real estate investor? Okay. If I take my money out of my retirement account and instead of invest it in a mutual fund, I invest it with you. Okay? I can make a loan to you. What are you going to use my money for?
Buy a house, rehab it.
Buy a house, rehab it. What area? Just curious.
Local.
Here, local, okay. I'm familiar with this area now, but I know people here. I know a lot of people that live out here. And are you going to buy an ugly house or a pretty house?
If the numbers work, I'll buy the house.
Okay, ugly or pretty, right? A lot of real estate investors look for what? The ugly house, right? We buy ugly houses. They want the ugly house because that's where the opportunity is. That's where the gutter's falling down, grass is overgrown. Parents are saying, kids don't play in that yard. That's the house most real estate investors are buying. Okay? And for using my money, I'm sure that we could drop a promissory note, have an attorney draft that. You can pay me above average interest on my money? Yeah. Big nod, yeah. Well, I mean, we both want to be happy, right? Okay? And we can close at a title company, right? So my money's secured by the real estate, just like a bank, okay? And now that you have my money and I'm secured and I can sleep at night after we agree to terms, what's going to happen? I'm sure you're going to take it from ugly to pretty, and who's going to do that work? So contractors, right? Contractors are going to hire You're not swinging the hammer, nor am I, right? So we got that in common. Is there a contractor in this room? Any contractors in this room? There we go, there's a contractor right there. There's another one in the back. So with my money, not only can I loan it to you, the local real estate investor, who I hope you knock it out of the park and pay me my principal and interest and on we go, but also I know with my money you're hiring contractors who are hiring subcontractors who are putting money back into local businesses when they have to go buy lumber or utilities and all those types of things. Okay? And then when we're done with that house, when you're done with that house, I should say, when you're done, you put up the white picket fence, and then what do? You sell it, right? Sell it to a family that needs a home, provide the American dream of home ownership. Maybe you just keep it as a rental and put that in your rental portfolio, or maybe you turn around and maybe even sell or finance it to a family that can't get conventional financing at a bank. But the thing I like about that is not only am I getting above average interest, there's a lot of people that are also benefiting from that investment. Okay? Now, I actually like to do loans in Houston. Why? Is it because I just love Houston more than actually I love a lot of places? But why do I loan in Houston? Because I know that my IRA investment is not only giving me above average return, but it's making my community and my neighborhood a nicer place to be, okay, with my money. And that's what we talk about when we talk about you thinking of your IRA in a socially conscious fashion, okay? Instead of investing into some, maybe nameless mutual fund. So it's a little bit cheesy, but I see it on an everyday basis where real estate investors are taking other people's retirement accounts and doing something positive in our community. And then when you pay me back my interest, what do you think I want to do the next day? Let's do it again, right? What's your next deal? I kind of like that. Okay, so you want to think about that when you think about retirement accounts. It's not always about making money. I know everybody in here wants to make money, but you also want to think about what else is your retirement doing. Okay? Ask yourself the question, do I know what my retirement is invested in? If not, maybe you should go find out. And I hope this presentation just gets the idea in your head that you can do other things with your retirement account, make lots of money, but also have a positive social impact on your community. But when you invest in any fashion, IRA or not, I say just invest in what you know best. If you understand the stock market, more power to you, invest in the stock market. If you understand something else, understand that IRAs can hold title to just about anything. Okay? There's only two things you can't put in an IRA: life insurance contracts and collectibles. Anything else is fair game. So just because you can't hold real estate in your Fidelity account because they don't sell real estate doesn't mean you can't hold title to real estate in your IRA, okay, and other things. But I always say just invest in what you know best. You'll make better returns for yourself if you do it that way. Here's the meat and potatoes of the presentation, and something that I always tell people is if you don't have all of these plans, or if you don't have all the plans that you're qualified for, think about opening all the plans that you're qualified for. And I'll talk about the benefits of doing that. But when we talk about IRAs and self-directed IRAs, there's 3 categories of plans that you can set up for yourself or your family. And just remember, they all have better tax benefits than us as individuals. Okay? All of these accounts, at a bare minimum, grow tax deferred. And in some cases, if you play your cards right, your profit's completely tax-free. Okay? Traditional IRAs and Roth IRAs are the ones most people are familiar with. Okay? Those are your pre-tax and your after-tax accounts. And if you've had a 401k rolled over into one of these plans, you know what I'm talking about. But anybody with earned income can have one of these plans and make contributions to it. Obviously, I think most people in this room understand the difference between a traditional IRA and a Roth IRA. Okay? One grows tax deferred, that's the traditional IRA, meaning you put money in there, you probably get a tax deduction when you make contributions, so you get to write it off on your taxes the year you put it in. But ultimately, you pay taxes on the entire bucket. You just don't see it until you start taking distributions, right? So if you take $100,000 and make it into $1 million in a traditional IRA, do you really have $1 million? No, you have about $1 million minus taxes. You're going to owe Uncle Sam his portion each time you take distributions. And when you pass, because we do die at some point, all of us unfortunately, your IRAs, if they're traditional, pass on to your next generation, but then who pays the taxes on that now? Your next generation does, and assumingly, if they're still in their working years, they're probably paying higher taxes than you are in retirement, okay? But when you hear all the gurus talk, and me and Quincy will get up here and talk, and David will talk, and everybody will talk, they always talk about the power of the Roth IRA. The power of the Roth IRA. The ability to put money in a retirement account that not only grows tax deferred, meaning you buy and sell 10 homes, you pay no capital gains tax whatsoever. Okay? You can grow the bucket much, much faster because you don't have to pay taxes annually. But if you play your cards right with the Roth IRA, what happens is all of your distributions for the rest of your life, and when it passes to your next generation, they get to come out completely tax-free and penalty-free. So if you rewind that whole story and start with $100,000, but the taxes have been paid, right? You haven't taken tax deductions on it. It's in a Roth IRA after tax. The trade-off is once you've had the Roth IRA open for 5 years and you're above the age of 59 and a half, all of the distributions out of that Roth IRA are tax-free and penalty-free for the rest of your life. So if you think about that for a second, that becomes really powerful when you think real estate. Okay? Because I see a lot of clients of ours have creative ways to take title to real estate. You don't even need hundreds of thousands of dollars to take title to real estate in an IRA. I see clients invest in property by subject to. I'm not going to go over that, but that's subject to underlying financing. I see clients use IRA loans as a way to leverage smaller IRAs to grow them bigger. But if you can fast forward in time and get yourself to a place to where you've had a Roth IRA open for 5 years, you're above the age of 59 and a half, so all the distributions are qualified and tax-free, and let's say you have 10 or 12 rental properties held in that Roth IRA. You can live tax-free for the rest of your life just off the rents from those investments. You can even sell property and reinvest in other property and keep the bucket growing, and literally live off the grid, tax-free for the rest of your life. Do you guys think the IRS likes that idea? No. There's actually audit triggers. Like I say, talk to John Hare about it, but he'll tell you about maybe opening up several different Roth IRAs so that you don't have one ginormous Roth IRA, because Mr. IRS doesn't like to see ginormous Roth IRAs because they're always thinking, are we owed anything on that? Okay, but as the rules are now, is you can grow infinite amounts of tax-free wealth within a Roth IRA. And if you've got enough money in a Roth IRA and you're above 59 and a half, I would say, why would you ever do an investment in your name again? You're a taxpayer. Do every investment you can in a Roth IRA or some of the other tax-free accounts and just live tax-free off the distributions forever. Okay? And when you think about leaving a legacy to your kids or your grandkids, remember when a Roth IRA passes on to the next generation, the taxes have already been paid. So you give that opportunity to your next generation to grow tax-free wealth that way. If you're self-employed, you can also contribute and self-direct employer plans. How many people are self-employed in here? 1099 income schedule C, okay, good amount. This is just another bucket for you to use, and I don't have time to go over the whole class on employer plans, but the thing that's different with the employer plans, that's different than personal and specialty plans, I would say, is the ability to make large contributions, okay? And I'll talk about contribution limits on the next slide, but you can contribute massive amounts of money into an employer plan if your income justifies it, okay? Close to $60,000 in some case. Whereas you're limited with the personal plans to either $6,000 or $7,000. Now that's just contribution. Contribution is what you add to the account. Don't get contribution confused with profit. Profit's unlimited. You can make as much money as you can on the investment. What you add to the account annually is limited. But if you're looking to shelter more money away from Uncle Sam and you're self-employed, well, these employer plans will allow you to make larger contributions than if you're just using the personal plans. So again, it goes back to what I said earlier. Identify all the plans that you can have that you can make contributions to that give you tax shelter. And here's what a lot of our savvy self-employed investors do at Quest. A lot of them might have, say, a SEP IRA, for example. Okay, SEP IRA, you can make contributions of up to $56,000, okay, if your income justifies it. But that SEP IRA is just like a traditional IRA. By definition, it is a traditional IRA. It just allows you to make larger contributions. Okay, so a lot of people say, well, I can only put $7,000 into my Roth. Where am I going to go with that? Are you self-employed? Can you make a $50,000, $60,000 contribution to a SEP IRA? Because here's what a lot of our clients do. They just use that SEP IRA to make a large contribution each year, and what do you think they do with it right after that? They just convert it to their Roth. Because now, how the rules are, ever since 2010, anybody, regardless of your income, can convert traditional and SEP IRAs, pay the tax on it to just move it to a Roth IRA, okay? I'm going to talk a little bit about that on the tax strategies on how you can use conversions to maximize your tax savings. Okay? So always think about how can I use these plans, how much money can I stash into them. And these plans I love talking about because these are the plans that work a little different than the retirement plans here. Right? Most of these plans you're not going to want to use until after 59.5. But what do you do about expenses that you might need today? Everybody's got needs today. You can actually have accounts set up that might facilitate some of the expenses you have right now, even if you're way younger than 59.5. How many people in here have kids? How many people in here have health expenses? Okay, a third of the room has health expenses. What do you guys eat up here? That 2/3 of the room, they don't have? I always like to make that joke because everybody has health expenses, even if you're young, okay? And by health expenses, I'm talking about how did you pay for your glasses, okay? That's a medical expense, okay? How did you pay for your prescriptions or the last time you went to the dentist? Did you reach in your back pocket and pay out some money? That's a medical expense. And obviously, as you get older in life, the medical expenses increase. But one of the things with medical expenses and education expenses, I'm sure most of you guys are aware, those have been on the rise faster than anything, okay? Education's getting more expensive and healthcare is getting more expensive. If you can understand how to use a health savings account and a Coverdell education savings account, your investments can pay for the education of your children and pay for the health expenses for you and your family with completely tax-free dollars. Okay, we have classes that go over how these work and the benefits to each of them. But if you switch your mindset as an investor, and instead of paying for all those expenses with what most people pay it for, what do most people pay those expenses with? HIP National, right? Your most expensive bucket of money. Like you said, after tax. So if I have $10,000 of education expenses or $10,000 of medical expenses that I have to pay, okay, and I'm an investor trying to make investments to earn income to pay that, I have to make more than $10,000 if I'm doing it with my money because I have to pay taxes. So that means I have to go out and make $16,000 or $17,000 first, pay taxes, and then I have $10,000 left over to pay those expenses. If you just switch your mindset for a second, and if you've got an investment that might make you $17,000, and it's for the purpose of paying for your education expenses and health expenses, do the investment in your Coverdell or your children's Coverdell or your health savings account, because you keep all of the profit free of tax, and it gives you the ability to consume more goods with the same amount of money. Now, when you look at all these, there's a lot of different accounts that give you tax benefits, and I think that the power in all this is the ability to open up several accounts and partner them together. Okay, I'm going to skip this, and partner them together. Here's the power play I believe. Everybody in this room should have a Roth IRA. Everybody in this room should have a Coverdell education account for any of their children or grandchildren. And if you haven't set it up now, you just got to set it up prior to them being the age of 18. Okay? 18 is the cutoff for making contributions to an ESA. Everybody should have an HSA if it fits your needs, and this is a class on that. And everyone, if you have the ability to open a Roth 401k if you're self-employed, what a wonderful tool a Roth 401k is. Now, the reason I picked these accounts out right here is that these are the accounts that if you can learn how to put investments in these accounts, all of the distributions are tax-free and penalty-free forever. Okay, that's the power play right there. I've got all these accounts besides the Roth 401k because I'm not self-employed, but I have all of these accounts right here, and so does Quincy. Okay? So this is your power play. I think everybody in this room should have these types of accounts. So what do you do? Once you find out, okay, I want to start putting some investments into these accounts so I pay less in taxes, okay, what are the steps to doing it? Well, first, you have to open an account that allows you to have real estate investments or note investments or whatever it is. You have to have a self-directed account that allows you to do that. There's other companies that do what we do, but they all suck, so just use us, okay? We got a booth outside. That's a joke, guys, come on. I will tell you this, though. With self-directed IRAs, there's a lot of different self-directed IRA companies. Some of them are really good, okay? Be careful on the ones that don't understand the strategy that you're investing in, whether it's real estate, note investments, or whatever creative investments that you have. I will tell you with Quest, and being that we all get our education trickled down from Quincy, is that we understand all the complex investment strategies that you guys want to do. Okay? All the complex investment strategies you guys want to do, we have funded all of those investments, and we funded them through self-directed IRAs. So I think the benefit to using Quest is that we understand the investments that you guys are trying to do, and then once you decide that you want to open your accounts, you fund them. There's several different ways you could put money in them. You can put money in as a contribution. You can just make annual contributions, and right now we're in the best time to make those contributions because you can make contributions for last year, 2019, and you can make contributions for this year. So a lot of people right now are double dipping and putting both years' contributions in there to get money in ready for an investment. You can also transfer money from another IRA. That's what a lot of people like to do. Or if you've got an old 401k, an old 403b, some old employer plan that you're not with that company anymore typically, you can roll that into a self-directed IRA. Those are the three ways to fund it. And here's the important part. What do you do once you get a self-directed IRA set up and it's funded, is that you find the investment. Okay? Now, how do you find investments when it comes to self-directed IRAs when we don't sell investments? Well, one start is just looking around here. Right here is where you can start finding some investments. And I know Jim likes to talk about the power of networking. With self-directed IRAs, it's important to build a network because you have to find your own investments. That's a key part of it. When I'm talking to rooms like this, I know you guys get that because a self-directed IRA is an entrepreneurial type of IRA. You have to go out there and actively find your investments. So it's not the best fit for everybody. If you're a lazy person that just wants to sit back and have investments come to them, the self-directed IRA isn't going to allow you to do that. But it does allow you to grow your investments tax-free, but you've got to build a network so that you can locate your investments, whatever those investments are. I'm going to go over some case studies and show you different types of investment strategies that our clients are using within these accounts. But Quincy would not be happy with me if I didn't at least mention the quick, boring part about self-directed IRAs, which is prohibited transactions. Okay, dun, dun, dun. I know Quincy loves to talk about prohibited transactions. I'm just going to breeze over this. I already saw one guy shaking his head about this. The reason I have to go over this, I just want to make sure for those of you who are not familiar with self-directed IRAs, what you're not allowed to do in a self-directed IRA. The main thing you're not allowed to do with any of your IRAs, whether they're self-directed or otherwise, is you can't use your IRAs and self-deal them back to yourself. Okay? You're the fiduciary of your IRAs and your qualified plans. Fiduciary meaning you have a responsibility to have your IRA grow. But your benefit from your IRA comes when? From distributions, right? When you take distributions, that's when you get your benefit out of your IRA. But you can't get benefit from it before then, meaning if I have an IRA and I'm also a real estate investor, I can't tell my IRA to make a loan to myself, because who makes the decisions for both of those people? I do. Think I can strike up some pretty fancy deals dealing with myself? Right? That would be a conflict of interest. So I'm not allowed to use my IRA to loan to myself, or my spouse, my parents, my grandparents, my kids or grandkids, or any other fiduciaries to the plan. It's really restricted away from investing in the people that might inherit my IRA at some point. Okay? I can't loan it to my lineal ascendants, lineal descendants, my spouse, and that's pretty much it. Okay? It doesn't catch much people. Just understand who is disqualified to doing transactions with your IRA, and John Hare is very good at explaining why you don't want to do this and why you don't want to mess with these rules. Never get caught doing something prohibited in your IRA, because the IRS is not nice to us when they find out that we've taken advantage of those rules. Okay? They basically distribute your entire IRA to you if you do something like that. So again, not spending too much time on this, but I will just tell you, don't be cheaters with your IRAs, okay? I know, you guys get it, right? Some of you guys get it. Too soon? Too soon? I'm from Houston, though. I can say this, right? I'm from Houston, okay? So just don't be a cheater with your IRA, because cheaters lose. We know this, okay? But once you understand who your IRA cannot invest with, that leaves you so many other people that you can invest with, okay? I can't invest my IRA to myself. But how many people are in this room? 180, I think was what they said. Okay? All 180 of you are not disqualified to me. So my IRA can do a transaction to you. Okay? I would say the power of the network also allows you to build wealth within groups. A lot of the Quest clients work really well together, because what they do is they go on these IRA fund cruises, they meet, they network. They're not disqualified to one another. And what they end up doing, and that's where the term came from, if you guys are interested, a lot of people go on the IRA fund cruise and the Financial Friends Network. Financial Friends Network. Okay, what's the whole purpose of that? Why did Quincy put that on? Because Quincy understood from a very early start that if he had to have a self-directed IRA and find investments, he needed a network. How many people have been on an IRA fund cruise before? Okay, yeah, pretty fun, right? Okay. I got chased by a guy with a machete in Jamaica on the one that I went on. That's the story Jim wanted me to tell you, okay? And I'm not, see, the hard part about it is everyone wants me to tell that story, but I'm also supposed to promote the IRA fund cruise. So it's very hard for me to convince people to go on the cruise if I tell them that story first, okay? And a lot of you know how Quincy works, okay? After this happened, and it's a true story. I didn't make this up. There's no reason for me to make it up, okay? Me and another Quest coworker, we got chased by a guy with a machete. We just ran out of an alley, and he was on something. Obviously, we didn't have time to ask him, okay? And we basically just went back to the boat. Now, when I caught up with Quincy later, Quincy asked me, did I take a picture? Sorry, Quincy, I didn't have time to reach in my phone and take a selfie while I was running, okay? But Quincy loves for me to tell this story because he just likes to laugh at me, I guess. But anyways, but go on the IRA fund cruise. I'm sure it won't happen to you guys, just me. So what are some investment options we see at Quest? Okay, we have $2 billion under a management. Obviously, we don't sell investments, but what are the most common investments that we see? Well, these are probably the three categories of investments that we hold under administration. Okay? We hold direct purchase of real estate, direct ownership of real estate in a retirement account. Okay? Very few of our clients actually hold direct ownership of real estate, meaning the IRA is on title. Right? Quest Trust Company, for the benefit of, client's name and account number. That's the owner on title. Okay? Even though real estate's a great investment, why do only 12% of our clients invest in real estate directly through their IRA? What's that? Liability? Most of our clients are not active real estate investors. You guys know what I mean? They're not actively out there door knocking, doing marketing, finding their own investments. We have some clients that do that. They do phenomenal by holding title to real estate in their IRA. But out of the 20,000 clients we have, that is not our average client. Our average client still works 9-to-5 job. They just have found a way to invest through a self-directed IRA that gives them above average return, but they don't have to do the work. And that's why you see 80% of our assets are held as private entity assets or promissory note assets within an IRA. Okay? Now, a lot of the private entities that our Quest clients invest in, the entities own real estate. You guys get that, right? We have a lot of clients with a lot of investors that use self-directed IRAs to fund some of their big projects. For instance, if you're going to buy an apartment building, a commercial property, a healthcare facility, all sorts of investments that somebody might be looking to raise money for, Okay? That investment is going to be owned in the name of an LLC or a partnership or something like that. It's owned in an entity. Okay? But the shareholders of that entity or the people that are invested into that entity, oftentimes, a lot of them, a large percentage of it, is owned by IRAs. Now, the benefit to that, if you're a client, is that, again, you're not the one doing the work. Okay? You get income based on whatever the agreement is between that LLC and your IRA. Okay, but you get passive income from that investment without doing any of the legwork. Promissory notes is the largest asset class that we hold at Quest. Okay, 40% of our assets under management are promissory notes. Okay, just a piece of paper, an IOU, okay, promise to pay. Now, most of those promises to pay are secured by real estate. So the investment, hypothetically, that me and you did, I would own a promissory note in my IRA. Okay? My IRA would be the lender, or my IRAs would be the lender. And then when you pay interest, you pay it back to Quest. You don't pay it to me, the taxpayer. You pay it back to Quest. And all those interest payments go in completely tax-free. So again, that's passive for me. Most of our clients like to be passive. And when you go out there and you network with people who are not active investors, remember, most people would rather just give you the money if they trust you, and then just get the mailbox money, I like to say. Right? No work, mailbox money. And here's the other thing. When you go out there, you should be talking about retirement accounts. Okay? You're not going to put people to sleep if you talk about it in a fashion where it might make them higher returns than what they're making now. And I'll give you an example. I'm sure everybody in this room knows somebody that's not disqualified to them that has a retirement account. Most likely, 98% chance, it's at Fidelity, or it's at Charles Schwab, or it's at their local bank. Listen, or maybe even ask, what are they invested in? If you hear keywords like, I have a CD. CD, right? No offense to anybody who's got a CD, but I love these things. Jeff Watson, if you guys know Jeff Watson, he calls them certificates of depression. What's the average return on a CD? 2 are the good ones, right? A lot of them are 1%. But this is what we are taught to invest in. Because if we want to preserve our wealth, and we're maybe even past retirement, our wealth advisors say, you don't want to lose your principal. You need to be safe with this money. We'll keep it for several years, and we'll pay you a guaranteed 1% return. Okay? Woo, 1%. Okay? Well, if you calculate inflation's 3.5%, okay, you're not even keeping up with inflation. What's that mean to your retirement account? You're just getting broke safely. You just don't see it. But if you find somebody that has that type of investment, ask yourself, could I pay them 6% secured by real estate? Okay. Could I borrow their money, secure it by the property, talk about all the social impacts that this investment's going to have, and can I pay them 6% or 7% or even 8%? So the interest rate's negotiable. That's not only a life-changing event for you, the ability to use retirement accounts with no use of your credit or no use of your income, but that's a life-changing event to them, isn't it? If you can take them from 1% return and turn it into 6%, is that not your ability as a real estate investor to help other people retire faster? Tom Barry's going to come up here and speak. I might have to remind Tom, ask him about the story about, because he's used Quest IRA money from other clients for many, many years. He has a lot of IRA lenders that like to loan to him over the course of his career. Ask him about the story of him contacting his IRA lender who was fishing. Okay? I don't want too much of the story, but basically he just told Tom that he didn't need Tom anymore because basically Tom helped him retire faster. Okay, true story, okay? And he took him out of some investments that weren't profitable and basically just quadrupled his return by loaning it to, putting on different deals. So here are the I'm going to talk about 3 different strategies that from what I see, I think are the best and what everybody should be thinking about. Now, this is not investment advice, by the way, but this is the best way I think you can maximize your tax-free profits, okay, by these 3 strategies. The first one is I like to talk about Roth conversions. How many people in here have done a Roth conversion before? Okay? I'd say that because even though we talk a lot about Roth conversions, if you look at Quest, 86% of the transactions are done out of a traditional IRA. Okay? Now, why do most people do investments still in their traditional IRA? I think a lot of it comes to fear. They don't want to pay the taxes before they do this investment. But you got to realize you're going to pay the taxes one way or another. You either pay it now or you pay it later. If you're going to grow the big bucket and make it bigger, where would you rather pay it? On the big bucket or the small bucket? the small bucket. So this is a true story about a client who did not do a Roth conversion, okay? But it's okay, I already proved that I can tell this story, okay? So typical client, okay? Moved jobs, had a 401k at the company he was working with, and once you have separation of service from that company, now you have an opportunity to use that 401k into wherever you see fit. You can roll it to Fidelity or you can roll it to Quest. Now he decided to roll it to Quest because he wanted to buy real estate. Okay, so he rolled that 401k, and 99.9% of the time when you roll a 401k is usually pre-tax. You haven't paid the taxes on that money yet. When you roll it to a traditional IRA, it just rolls over into a pre-tax traditional IRA, okay, pre-tax to pre-tax. Now what he did is he rolled that money in, had a traditional IRA, found a property that he wanted to buy, made the offer in the name of the IRA, which read something similar to this, okay? Negotiated the terms and said, I want the buyer to be Quest Trust Company for the benefit of me and my IRA account number. He does the same legwork on finding the investment, it's just the buyer is different. The buyer is his IRA. Now in this transaction process, we signed the purchase contract because we're the administrator of the IRA, and we also then work with the title company to make sure that the deed is vested correctly in the name of the IRA. But remember, this is all done in the traditional IRA, pre-tax. But he did pretty good on this investment. There's the reason why I have the story up here. He bought this property, it was owned in the traditional IRA, okay? All of the income was coming back to his traditional IRA. Now when you have income, and for him, again, it's all cash deal, he was generating about $5,200 a month in rents. It's about $500 a unit, okay? Not a home run, but still pretty good, okay? There's several different ways you can collect the rents. He just had a property manager in place who collected all the rents, paid whatever expenses needed to be paid, and then whatever was left over, that just went as one check back to Quest and dumped into his traditional IRA. But remember, pre-tax. So he's doing pretty good. $5,200 a month was his average in that first year. That doesn't include common repairs, but that was his average net monthly income back to his IRA. If you just annualize that number, that's 19% cash on cash return. 19%. How many people would take 19% in here? All day long. That doesn't even account for appreciation. Okay, I don't know how many people are familiar with Houston. North of Houston, there's an area called the Woodlands. You guys familiar with the Woodlands? What do you guys think that property's worth? He bought it for $330,000 in the Woodlands in 2009. I think the last appraisal we got, and I'll talk about why we had an appraisal on it, $750. Okay, did pretty well for himself. But remember, this is all in what type of account? Traditional IRA. Okay, so this is back in 2009. The rents were $5,200 a month. He came to my office because I wanted to get this case study from him because I kind of knew about the investment. I didn't really look into his account to see what account he had it in. Okay, but the whole time he's telling me this story, I'm thinking, man, my nerdy IRA brain's going, and I'm going, did you ever think about converting this to a Roth before you did it? And he said, well, my CPA said I made too much money to do that. Well, I said, well, fire that guy. I hope you fired him a long time ago, because ever since 2010, you could have converted this. You could have paid the taxes on, maybe not $330, whatever it was worth in 2010. You could have paid the taxes on all of that and just kept the property held in your Roth IRA. And everything past that point, all that appreciation would have been completely tax-free. And all the rents would be completely tax-free. Okay? So here's the moral of the story, is if you're going to take a bucket and grow it much, much larger, think about whether or not it makes sense to pay the taxes first, okay, before you do the investment. But you can even, if you want to correct it, you can even do a conversion of the asset itself. And this is actually what he decided to do. After I had a consultation with him, I said, well, you know, you might not be able to convert the entire thing now, but what's your plan with this property? He said, well, I just want to leave it to my kids. I want to keep it in the IRA and I'll leave it to my kids so that they can get that cash flow. And I said, well, you know, by not converting it, they'll pay the taxes if you're okay with that. And he goes, well, no, I'd much rather pay the taxes so I can leave them a stronger legacy of tax-free wealth. So what he's decided to do, okay, is that he started converting this asset. Chipping away at it though, because when you convert an asset, it's not like converting cash. Converting cash, you know the value of cash. $100,000 is $100,000. When you convert an asset, we have to find the value of the asset, because when you take it from traditional to Roth, you just have to pay the taxes. Now how those taxes reported, we just send a 1099 for whatever the value is, or for whatever you decide to convert. But when you convert an asset, we have to ask for an appraisal. That's why we ask for an appraisal each year, because when he converts, He needs to know the value of what he's converting. So I will tell you, and this is not tell you to be shady with the rules or anything like that, but on a situation like this, get the laziest appraiser that you know. You guys get what I'm saying? Okay? The laziest appraiser you know, the one that you never go to because you know he never gets the value, throw him a bone with one of these. Because all you need to do, and what he does is he sends us an appraisal each year, and what he does is based on that value, he converts what he can afford. Whatever he can pay in taxes that year, he pays the taxes, and right now on title, if you looked up this property, it's 50% owned by his traditional and 50% owned by his Roth. Okay? Each year, the percentage of ownership in the Roth goes up, the percentage of ownership in the traditional goes down each time he converts. And he thinks in about a couple more years, he'll have everything, all the taxes paid, and everything will be owned in the Roth IRA. Does that make sense? Okay? If you think about this prior to, though, you could see how much money in taxes he could have saved himself had he planned that out and had a better CPA that understood the rules. But I think if you're going to be an investor and grow your money and pass it on, pay the taxes first. Rip the Band-Aid off, get the taxes out of the way, and I think Roth conversions give you the opportunity to not be somebody like this. Quincy actually sent me that on a text one time with no explanation. He just sends it to me. That's kind of the life I live right now. Yeah. All right. Number 2 strategy that I like to talk about is leverage. Okay? Leverage is something that's powerful, especially with IRAs. Because not everybody has $1 million or $500,000 in an IRA, so how do you grow smaller accounts? Okay? Well, the power of leverage can be used with your IRA. Now, most people, when they think leverage, they think of leveraged money. Okay? Money can be leveraged, but other things can be leveraged too. Your strategy can be leveraged. Okay? All types of things can be used as leverage, but when you talk about money being leveraged, understand that IRAs can get loans. There are banks that have IRA loans, believe it or not. Okay? Now, this isn't Wells Fargo or Chase or Bank of America. They'll have no idea what you're talking about if you go in there and say, hey, can my IRA get a loan? Okay? But if you talk to banks like North American Savings Bank or First Western Federal, or there's a whole list of companies out there that offer IRA loans. Now, why is that important? Well, it's important because if you want to buy more assets with the use of leverage, your IRA can do it. Now, the loan's a little different. Okay, because it's an IRA and there's no credit it can qualify with and there's no income, basically the banks that usually like to do this is they ask for a larger down payment because that's the safety net to the bank. They want at least 30 to 40% in equity in case the property value goes down because they only have recourse to the property. They don't have recourse to you individually. They don't have recourse to your IRA. They only have recourse to the property, which could be good. Okay? Not that you want to lose it to the bank, but that's good because it doesn't affect you personally. Does that make sense? Okay? But when you use these accounts, remember that some of the banks work a little bit different. It's kind of a niche product. If you go to NASB, North American Savings Bank, I'll tell you, they like income-producing property with at least 30 to 40% down. Income-producing property meaning a rental property. They'll do that all day long. Okay? They'll do some multifamily property, but they won't do land. Okay? Because land isn't an income-producing property in their eyes. Does that mean there are other banks that will not do it? There are other banks that would do it, and I will tell you, this is a doctor in Texas. He went to his local bank, local community bank. He had a good relationship with the bankers there, and basically they decided that their bank would issue his IRA a non-recourse loan for his IRA to buy land. Okay? So what he did is he made an offer to purchase this land for $438,000, and he got a loan, his IRA got a loan for $307,000. Okay? The terms of that loan was at an 8.15% fixed, non-recourse loan, again secured by land, which only had him or required him to put up $137,000 from his IRA. Okay? Now, I will tell you, okay, that there is a tax that kicks in when your IRA borrows money. I don't have time to go over this, it's a little bit more complex, but what I will tell you, don't be scared of this tax. All it means is that if your IRA borrows money to buy its investment, the percentage that you borrow, you have to pay a little bit of tax on that portion of the profit. It doesn't mean that the investment's bad. You'll see why here in a second. It just means you have to be aware of that tax. It's called unrelated debt finance income tax. I'm not going to bore you guys to death with that, but I will tell you a tax kicks in even on this investment. Okay? But even with that tax, okay, and here's the tax calculated after the 18 months of him owning this property, The UDFI tax is only $12,000, meaning by leveraging money from his bank, his IRA was able to profit $111,000 after paying tax, which was 81% over 18 months. Raise your hand if you take 81%. Okay, even better. Okay, 81%. Now some people say, well, that tax, I don't want to pay tax if it's in my IRA. Well, let's look at it, if you look at it a cash-on-cash return basis, let's look at it if he didn't use leverage. If he didn't use leverage, the purchase price is the same, okay, sales price is the same, but you would eliminate the tax. And the payments that he had to make to the bank also are included in that. So his net profit would have been $175,000, but without the leverage from the bank, he would have had to come in with the entire purchase price, which leaves him less to invest with. Okay? But if you're looking at cash-on-cash return, if he has to come with everything to the table, his cash-on-cash return drops significantly, doesn't it? 40% instead of 80%. Okay? Consult with the CPA that understands this, but again, I always like to show that, because if you're thinking about investing, you want to think about how you can use all the types of leverage that give you the best cash-on-cash return and give you the best safety and security. Tangible investment, land in Texas isn't going anywhere. They like to say they're not building any more of it, so land can be a good investment opportunity. And then the ability to use leverage from a bank enabled him to make better returns for himself. So if you have a small IRA, that shouldn't stop you. Ask Quest and ask us how we can show you how to use some leverage, and ask some of the speakers how you can use leverage. And this is just one example of how you can use leverage with your IRA. Okay? And here's the last one I want to talk about that I really like, that I do personally, is promissory note investing. Anybody a promissory note investor in here? Okay, about 20% of the room, 10% of the room. This is the one that most of our clients like to do. Promissory note investment secured by real estate. The IRA is a bank. Do banks make pretty good money in this country? I would say so. Our clients actually make pretty good returns for themselves not doing any of the work by just owning promissory notes where your IRA is the lender. Okay? I like to do it. I've even partnered with Quincy on some of the loans that he's done where we had our IRAs partnered together as a lender to a real estate investor. Now, why do we like to do that? Quincy always likes to say he hates that four-letter word work. Okay? Somebody else is doing the work for us, so it's completely passive in that regard. The ability to negotiate your terms where you get mailbox money based on the interest payments. That's a great thing. You get to sleep at night. Your money's secured by real estate and you get interest payments that just come in the mail, okay, or come to Quest. If you don't get the payments, what happens? Well, you might have to foreclose, or you might have to go through that process, but that's not the end of the world. The fact that you're collateralized by something tangible should help you sleep at night. And again, less work means more time to yourself. And here's the thing that I like, especially when you talk about lending and IRAs, is that lending in an IRA, I would say most people are not in the business of making loans out of their IRA to do 30-year mortgages. Okay? Most investors are investing or loaning to people who are investors. So you own loans secured by investment property. But what we like to do is, we don't like to be, forgive me for saying this, married to you guys forever on a loan. We want to be in the investment and out of the investment and maybe on to the next investment. But why is that powerful when you talk about lending? You have that opportunity to loan and deploy your money out, get the principal back and the interest back, and a lot of times we just do one-year notes, maybe 2 years if we find that that's reasonable, but usually one-year note. We loan the money out, 1 year, we get the principal back, and now we got a chunk of interest. Now what do we do with that? We can compound that. Okay, we can be in and out and we can compound our interest, and that is a positive thing, and that's a huge thing when you talk about the ability to compound your interest by just doing hard money loans or private money loans. What's the key to that? You got to have deal flow, okay, or access to deal flow. Where do you find access to deal flow? Where do you find access to deals? Again, places like this. Places like our Quest Expo. If you can find enough financial friends that have enough deals to keep your IRA growing and compounding with interest, that's when this stuff becomes very, very powerful. And like Einstein says, compound interest is the eighth wonder of the world, and he who understands it earns it, and he who doesn't pays it. Okay? So if Einstein said it, it has to be true, right? So picture of Quincy, right? And here's what he would say. Promissory note investing allows him to sit back, relax, and eliminate the tax. I will tell you this is an old picture, obviously, because you can see the hair. Okay? He does still wear the shoes, though. Same shoes in the picture. So yeah, you know, Quincy's a great event. He's very frugal though. You see him, same shoes, same shirt, but that's our Q man right there. Same tie. I've tried to get rid of that tie many times. He does not let me throw that tie away. I don't know if it means something, but yeah, that's a nice one. So key points to remember, it's not about how much money you make, it's about how much money you keep. You guys are gonna learn a lot of different strategies from a lot of successful investors, but remember, the most successful investor on earth, the person that can do as many deals as possible, you're still not gonna get to retirement if you're not figuring out a way to minimize or eliminate the tax. Okay? And self-directed IRAs allow you to eliminate the tax through use of Roth IRAs, health savings accounts, education savings accounts, and even your Roth 401k. Self-directed IRA accounts are also a great place of private capital. If you're looking to borrow money for your deals, it's important to understand how the self-directed IRA works. And this might be biased, but I would say before you borrow money from someone else's self-directed IRA, I think you should have a self-directed IRA. I just think that's an awkward statement for you to ask somebody to set up a self-directed IRA to loan you money, and then they ask you, well, do you have a self-directed IRA? And you say no, but I want you to have one. Okay? Have one, and it also enables you to talk more fluently about it. Go through the process of how an investment works, and you can talk to people more about it, and it'll make that a conversation a lot smoother, I think. Okay? And deal makers build a network. If you're going to be an investor, especially a self-directed IRA investor, you've got to build a network. And if this is your first time here, this is a great place to start. And this is just the start. Okay? A lot of you guys, I see familiar faces. You guys go to all the things because you guys understand that deal makers build a network, and especially with self-directed IRAs, you have to do that. I'm going to give them a special promo, if that's okay. How many people in here are current Quest clients? Okay. About half the room. I still got something for you guys too. How many people have been to the Quest Expo? Okay, would you guys recommend it? Yeah, good event. Okay, I like this event. I like the Quest Expo. I think you should go to all the events that you can. So if you're not a Quest client, we're going to give you a special deal. Okay, we're going to allow you to open as many accounts as you want, provided that you meet Derek and at least get with him at least today or tomorrow. We'll be here from today and tomorrow. We'll let you open as many accounts as you want with no application costs. So that means Roth IRAs, traditional IRAs if you want to move those over, health savings account, education savings accounts for your kids. We're not going to charge you anything up front to get those set up. And it doesn't obligate you to anything. You can decide on next week that you want to close them down, but I don't see a reason why you would, provided that you have investments you can put in these accounts. So we're not going to fee you to death. We're going to give you guys the opportunity to open as many as you want for no application cost. And an additional thing that we want to throw out to you guys, anybody in this room, okay, obviously you have to have an account for this, okay, current clients or new clients. If you submit a transfer form to us, bring a transfer form to Derek, doesn't matter how much you transfer, okay, $100, whatever. At least get the account set up and funded that way. If you submit a transfer form to him, we'll give you a free ticket to the 2020 Expo. Okay. 2020, it's August, end of August. I think the information's up on the website. I want to say August 24th. Yeah. We're looking at about 1,000 people there. For those of you who came last year, we had over 800 there.
Where is it?
Houston, Texas. Houston, Texas. We can't pay for the flight, unfortunately, okay? But I will give you a free ticket. And for those of you who like the VIP tickets, if you guys want the VIP ticket, you can just add that as a credit, so you just pay the difference. Does that make sense? That's about a $200 value right there, guys. So again, we'll let you open the accounts for free. We'll give you a $200 Expo ticket just by meeting with Derek, giving him an application and a transfer form. And I hope this was helpful to you guys. Was this helpful? A little bit? Oh, VIP ticket? We'll talk about that out there. But VIP, everyone wants to be a VIP. I guarantee that. So that's all I got, guys.
Good. How about a nice?